Barclays got caught doing illegal trading and they paid just a $5.45 fine per trade. Now imagine being one of the biggest high street banks in the world, making millions from illegal trades, getting caught and then paying what works out to be $5.45 per trade. Not some shady unknown hedge fund, not some offshore operation. We're talking about Barclays, and yes, that's Barclays Bank. The same Barclays millions of people trust with their savings, mortgages, business accounts and pensions. According to a case involving FINRA, Barclays executed over 25,000 short sale orders without properly locating the shares to borrow first, something known as naked short selling, which falls under illegal activity under the regulations. Now, the result was $140,000 fine. That is it. No massive scandal, no huge media outrage, no endless headlines. Just a fine, and everybody now seems to have moved on. So today we need to ask the real question. Are financial penalties actually designed to stop bad behaviour? Or are they simply the cost of doing business for the biggest institutions on earth? Because if the rules are different for the people at the top, you need to understand the game you're actually playing. So let's get into it.
I am not a financial advisor. This video is based solely on my opinion on what I'm personally doing in this market. I also want to let you know that some of the links below and in the descriptions are affiliate links, meaning I may get a commission, but it will be at no extra cost to you. Please remember that under no circumstances will I ever contact you and ask you for investments. You can confirm all of my real social media handles in the description and also at milkshakematty.com. This content is for educational and entertainment only, and I'm not a financial advisor.
First, what actually happened? Now, let's simplify this because people throw around terms like naked short selling and most people will instantly switch off. Here's what normal short selling is. You believe a stock is going to go down. So you borrow shares, sell them at today's price, then hopefully buy them back cheaper later. Then you return the shares and you keep the difference. That is legal. That happens every single day. Now, here's where it gets a little bit messy because naked short selling is when you sell shares without first properly locating or securing those shares borrowed. In simple terms, you're selling something before confirming you actually have access to it. That creates what many people call phantom shares. Now, artificially selling pressure does enter the market and that pressure can push prices down. And the average investor holding that stock may have absolutely no idea why the price is bleeding. Now, according to the report between December 2020 and May 2022, Barclays executed over 25,000 short sale orders without properly locating the securities available to borrow. That is where the issue has come from. Now, in April 2026, FINRA settled the matter. The penalty? $140,000. Now, if you would divide that by the number of violations, it works out to $5.45 per illegal trade, which is why the internet has exploded about this. Because let's be honest, that sounds ridiculous. That's why posts like this from the Bull Theory go viral, because they frame it like this. Barclays made millions, got caught, paid pennies, keeps the profits. And to normal people watching from the outside, that feels like corruption. It feels like the system is designed for one set of rules for them and another for everybody else. And honestly, I understand why people feel like that. Because if you or I broke financial regulations at scale, we're not paying a fine and then moving on quietly. We're probably in serious trouble. But the giant institutions, sometimes it feels like they can just settle, pay and continue. And that creates distrust. And distrust spreads fast, especially in crypto, because crypto people already question traditional finance. They already distrust the old system. So stories like this become rocket fuel. But we need balance. Now, here's where I want to slow things down, because emotional outrage gets views, but understanding gets results. And there is an important difference between a viral version of this story and the full reality. First of all, the fine is real. That part is true. But the claim that Barclays definitely made $15 million or more from these exact trades, that's not confirmed inside the settlement. That's an estimate, and that matters because social media loves turning estimates into facts. Second, not every naked short selling case is some evil mastermind plot. Sometimes it's deliberate abuse, and sometimes it's compliance failures, and sometimes it's systems failing to properly confirm and locate. Still serious? Of course it is, but not always the same as they created fake shares to crush the market, and that distinction matters. Third of all is people say they kept the profits. And sometimes, yes, regulators don't claw back everything, but firms can also face reputational damage, internal compliance costs, future restrictions, more scrutiny, and operational headaches. Still, I'll be honest, sometimes the punishment does feel too small, and that criticism is fair. Now, the bigger issue isn't just Barclays, it's the pattern, because this isn't a one-off. People will point to UBS, Citadel, Goldman Sachs, and many others that have done exactly the same. Again and again, we see massive institutions settling regulatory cases with fines that sound tiny compared to the scale of the operations. And that creates a dangerous perception. Fines are not punishment. They are business expenses. And once people believe that, trust collapses. Because trust is everything in finance. Banks run on trust. Markets run on trust. Crypto runs on trust. Even stablecoins run on trust. The second people believe the game is permanently rigged, confidence will disappear. And confidence disappearing is how financial systems break. Now, let's bring this back to us, because you might be thinking, Matty, I trade crypto. Why do I even care about Barclays and naked short selling of stocks? Because the lesson is much bigger than Barclays. The lesson is this: markets are not perfectly fair. They never were and they never will be. There are bigger players, faster players, better connected players, institutions with tools, access, and information that retail traders simply do not have. And that's the reality. But, and this is important, that does not mean retail cannot win. It means retail must stop playing emotionally. Because the average person loses money, not because Barclays existed, but because they chase green candles, they panic sell the red candles, and they trade with a zero plan. That is the truth. Most people blame conspiracies for the losses caused by poor discipline. That's the uncomfortable but true truth. The real edge is not being outraged at stories like this. The real edge is structure, risk management, patience, positioning, and understanding liquidity. Understanding where stop losses should sit. Understanding how market hunts emotion. That is the game. And that's why in the Wolfpack we focus so heavily on systems, because emotions get you wrecked. Systems keep you alive. And actually, talking about understanding how the system works behind the scenes, this is exactly why I'm so excited about what we've been building inside the UK Crypto Podcast. Honestly, we've had some incredible guests in the studio recently, and the episodes coming over the next few weeks are absolute bangers. We've already recorded them and they're now in editing, and I genuinely think some of these are going to be our best episodes yet. We've had the formal global vice president of Binance come into the studio for a complete tell-all story. That episode is fascinating because it gives you a perspective on crypto that very few people will ever get to hear. What it actually looks like operating at the very top of the biggest exchange in the world. We've also had a Web3 developer come in who built an incredible project and community only to be rugged for over $1 million US. And that episode is raw, it's honest, and it shows the dark side of the industry that most people never talk about. We've also had the CEO of the world's largest crypto publication into the studio talking about media, influence, narratives, and how crypto stories are shaped behind the scenes. And I'm especially excited for this one because we've had the head developer from the Crypto Wolfpack in talking about the automation project that he headed up. That system has now pushed over 30 million US dollars in trading volume over the last 30 days. And that episode goes deep in how the automation works, how it evolved, and what the future looks like. These are proper conversations, no surface level fluff, real stories, real operators, and real lessons. New episodes go live every single Friday at 7 p.m. UK time. And honestly, if you haven't checked out the UK Crypto Podcast yet, you're missing out. I'll link the full playlist at the end of this video so you can dive straight in after this. Definitely check it out. So let's return to the original question. Was Barclays treated too softly? And personally, I think the real issue is transparency, because if people understood clearly what happened, how much was made, what was recovered, and why penalties were chosen, there would be far less anger, because silence creates conspiracy and lack of clarity creates suspicion. And financial institutions are terrible at communication when things like this happen. They settle quietly, the stories disappear, and everybody is left assuming the worst. That's how trust dies. Not from bad actions, but from bad transparency. So, this is my honest view. Do I think the system is rigged? Not exactly. Do I think the biggest players have advantages? Absolutely they do. And do I think fines are sometimes too small? Yes, definitely, because $5 something per bad trade or illegal trade is ridiculous. Do I think retail investors need to understand that reality instead of pretending markets are perfectly fair? 100% I do. But I also think this: you cannot build wealth from a position of outrage. You build wealth from a strategy. You build wealth from discipline. You build wealth from understanding the game better than the average person. That applies to stocks. That applies to crypto. That applies everywhere. Because screaming that the system is rigged when you're on Twitter might get you some likes, but it won't grow your portfolio. Understanding liquidity might just grow your portfolio. Managing risk will definitely grow your portfolio. And staying calm while everybody else panics absolutely will grow your portfolio. This is where the money is. Now, my final thoughts is the most dangerous thing in investing is not corruption. It's believing you are powerless, because once you believe that, you stop learning, you stop improving, and you stop taking responsibility. And that is the fastest way to stay broke forever. Yes, the big players are powerful. Yes, the game is hard, but no, you are not helpless. The goal is not to beat Barclays at their own game. The goal is to understand the rules well enough that you stop becoming easy money for the markets. That is the difference. And that's the mindset we build here. So I want to ask you this. Do you think the fines like this are enough? Or are they just the cost of doing business for the big financial elite? Drop your thoughts in the comments. Generally, I want to hear where you stand on this subject. And if you've got value from this video, please hit that like button, hit the subscribe, and make sure you check out the UK Crypto Podcast playlist that I'll link right at the end of this video. I'll see you on the next one. And remember this: the strength of the wolf is in the pack.